Howdy, Jacob here. Today we're looking at a company that I'm sure most have heard of, more on the lines of their ticker symbol than their actual business name. So we're looking at IBM today. First things first, pretty big company, I guess you could say. $147.5 billion market cap, $185.4 billion enterprise value. It's a little bit of net debt there, 4.11% dividend yield. Let's look at the debt situation. So 24 million in 2012, just under double. Most recently in 46 billion. They have about 8 billion on cash equivalents. Let's look at what their free cash flow is looking like. All right, rolling 12 million last year, 9 billion, then 11 billion, 16 billion, 13 billion, 12 billion. So maybe a 11 billion, 12 billion on average. Let's say 12 billion. That's a little less than four times their 5 year average free cash flow. So nothing, it's not too concerning. Their interest expense might hinder margins a little bit due to almost four times 5 year average free cash flow, but not so concerning where I think the business is in trouble or anything. I'm assuming, let's see, might be some sell-offs here. 2014 to 2015, drop of $11 billion, and then 2018, 2019, drop of about $22 billion. So let's look if there was anything there. So uh, de-investment in 2014, I see that. I don't really see. Don't really see what happened 2018 to 2019. So that's looks like there was actually a huge investment in 2019. Um, okay, interesting. So let's see. This company definitely makes a lot of acquisitions. They spend a lot on acquisitions, and then as big as they are, they're definitely spending a lot on their dividend payout. We're seeing about 6 billion in payout, and like I said, 5 year average probably around 12 billion. So it's about a 50% payout ratio. That's reasonable for a company that's as big as IBM, where maybe they just don't think growth is necessarily in the cards. But they're still investing 3 billion the rolling 12 months. So that's good to see. They're trying, well, I guess it depends, right? So if it's successful, that's good to see. If not, then it'd be better to just give back to your shareholders. But I think we can get to set some assumptions here. So I want to say zero growth, but I think that IBM has found ways to grow in the past enough to where some of the businesses will grow, some won't. Maybe I'll put it at about a 2% revenue growth, and then it's not a moat, but I feel like so many people have heard about it, and there's something about consistency that people really like, and so I might put 14 on the P and price to free cash flow, and then 15% discount rate. As for margins, and 20. Let's try the 11, 16. So the free cash flow margin is so much bigger than the earnings margin, which definitely prefer that way. But so I might bump up their earnings margins to say that it converges a little bit. And as for shares, looks like been going up a little bit. Yeah. So their stock based compensation is more than their share buybacks. Um, so it looks like they bought back a bunch of shares between 2013 and 2019. Took away about 20% roughly of the shares, and then they've been relatively flat recently. So I might just say relatively flat. And then as for the dividend, I mean, we said 50% payout ratio. Let's see what they're doing. Increasing it at 1%. I think I'm fine with that. We'll say that Um, let's say 2%. Let's say they increase it 2% a year for the next 7 years. That gets us still nowhere really close to buy point with the 15% return. But again, this is a company that I'd put on my list if I'm interested in dividends, as they do have a 4% yield currently, and um, I think that that is a safe payout ratio that they have right now. And I think if the price gets cut even more, that's just going to only bump up the dividend yield, as I don't see them cutting their actual dividend payout. So yeah, I hope everyone enjoyed the video and has a good rest of their day.